So if you are applying for a home loan, at one point or another, you may have thought to yourself, how do the banks actually assess your loan application? What sort of stuff do they look for exactly? And you might be surprised to know there's actually quite a few things. Hey guys, welcome back. My name is Fyzee. On this channel, we look at Australian personal finance, and today we're looking at 5 of the main things banks look for when deciding to approve or decline your loan application. Now, once again, we are talking in a general sense only. This is not financial advice. I'm not a financial advisor, but I have worked as a mortgage broker in the past. I literally say this in every video, but it's true. I've dealt with hundreds of customers across Australia, and these things are what banks are looking for. Number 1, character. Now, you might be a wonderful person. I'm sure you are if you clicked on this video. Thank you, by the way. But if you apply for a loan, banks can only judge you by looking at the facts. You might know the bank manager or the branch manager for many, many years. You might even be quite friendly with them. But all of that doesn't really mean much when it comes to the actual home loan application. So basically what I mean is that lenders want to give money to people who have good character, meaning that if they ask for credit card statements or look at your existing liabilities, they want to see a consistent and good repayment history over a long period of time. And when looking at repayments, it doesn't necessarily have to be extra repayments. It just has to be the bare minimum at least, and the repayments have to be on time. Now, just some news for you. Currently, the banking system is actually changing. Now, what that means is that your credit cards, car loans, and personal loans with other banks will be shown on your credit report. So it's actually easier for the banks to see if you've been making your repayments on time. So now it's more important than ever. So even though your bank might not actually ask you for any statements on your application, they can still have a look at your repayment history. So just keep that in mind. Now, good character also means having a decent and hopefully good credit score as well. If you currently have all of these open right now at the same time, it's not usually the best sign. Similarly with character, they want to make sure that your jobs have been stable over the last 3 years at least. And they want to make sure that there haven't been too many job changes in that period. Now, when it comes to this, a lot of lenders actually follow a normal common sense approach. So as long as you can explain everything, it should be generally fine. Number 2 is capacity. This is basically your capacity to repay the home loan on time and successfully. Now, if you speak to some people, generally they will tell you that you can borrow 6 times your annual income. And that is true in many cases, but in some, that can actually vary by quite a lot. Depending on your lender, depending on the income type, how much debt you have, it can really vary. And if you need the highest borrowing power, it is often best to speak with a broker because they do have quite a lot of lenders on their panel. Now, speaking of brokers, if you are considering going through one, just make sure to ask them lots of questions. After all, you need them to be transparent so you can have trust in them. And if you don't know where to start, I made a video about the top 3 questions you should be asking your broker. So there's a link in the description, and there should be a pop-up on your screen as well. So go check that out. Some lenders will not go over 6 times your annual income at certain LVRs. Some can even go as high as 8 or more, but that's on a case-by-case basis. Now, keep in mind that this is not the only thing they look at. You might be earning $80,000 a year and you might think that you can borrow at least $480K, but then in the same scenario, you have a partner, you have 2 kids, some credit cards, and some other debt, and your borrowing power isn't as high as it once was. So along with that, they might also dig into your expenses by looking at your account statements, because after all, you have to make room for your mortgage repayments plus your expenses. You can't simply say to the bank that you will reduce your expenses to meet your mortgage repayments and you will change your ways after you get the home loan. I wish it worked like that. Your capacity is also impacted by the type of income that you earn. For example, if you get a lot of commission and your commission is like $3,000 per month and your normal salary is also $3K per month, generally speaking, your borrowing power would be more if you just earn the $6K per month as your normal salary and you earn no commission. If you're finding value so far, please leave a like or subscribe. It really helps out with the YouTube algorithm. Number 3, collateral. To put it simply, is just your property that the banks take as security for giving you the home loan. So of course, collateral is probably one of the biggest things that the banks look at, because if you can't pay the home loan, they want to make sure that they can at least sell the house and recover all their costs. So when the banks are looking at your house, they ideally want to make sure that the loan they're giving is at least 80% of the property value. Now, that is the ideal scenario, but of course, if you are buying a property for the very first time, you might not actually have enough deposit, and that's completely normal. So you might need to actually borrow above 80% and you'll pay a cost called LMI. This is basically an additional fee that you have to pay for not having a high enough deposit. Now, when it comes to LMI, if you want to know the ins and outs of how it works, how to avoid it, what it actually is, along with some very important information, I've made an in-depth video on LMI. There should be a link in the description and there should be a pop-up on the screen as well, so go check that one out as well. So when looking at collateral, banks do a valuation of your property, and the valuer will look at different risks based on where the property is, what the market conditions are, how quickly the property can be sold, and a bunch of other reasons. It's quite detailed, and all of this plays a role on what the value of your house actually is and how the banks look at it and how much they're actually willing to lend against your house. Number 4, capital. Now you can probably see a trend with all these names. They all start with a C, and this is actually because these are called the 5 C's of credit, if you were curious to know. So capital is basically how much money you personally have to contribute towards the loan. For example, if you're buying a house, how much deposit have you actually saved up so far? And can you at least save 5% of the property's purchase value and things like that? So basically speaking, if you can consistently save and you have a high deposit, it's quite a good sign, and vice versa, it's all fairly simple. Number 5, and the last and final, which is conditions. Now this is all about the actual terms of the loan, what you need the money for exactly, what type of loan is it, and does it actually make sense to give you that money? They also take into account if it actually matches what your financial goals are and what your ultimate goal is and what you're trying to achieve, to essentially make sure that you don't end up with a loan that is not fit for your needs. So hopefully guys, by knowing all this information, you now know what the banks look for and how they look at risk. And you can keep all of this in mind when applying. If you learned something new in this video, please like and subscribe, it really helps out. If you want to learn more about these topics, there's links in the descriptions for those videos, so go check them out. Thanks for watching guys, I'll see you in the next one. That's a wrap.